Welcome to the webinar. Thank you all for joining us once again. I hope you've all had a great week so far, and also that you can hear me. That's obviously important. Good morning, Kathy. Thank you very much for joining us. So yeah, I mean, to be honest, I think I've been looking forward to this week for some time, and the reason why is because good morning, Anita. I think the reason is because, funnily enough, there's nothing to talk about from a Brexit perspective. Now, for those of you who have attended previous webinars, you'll know that we always have to provide a Brexit update because, especially in the last few months, there's been so much happening on a weekly basis. It's important to understand it. Hello, Tammy. Thank you all for joining us. Yeah, there's been so much going on that it's worth understanding, especially if you're looking at sterling pairs, because it's such a major contributor. So this week is such a nice week because Parliament's in recess for Easter. Brexit Day has been kicked back by up to 6 months. It could be longer, which means we've got a bit of a relief from it. And it means we can focus on other things. There's so many more interesting things happening. And funnily enough, I think one of the more interesting things this week is actually the data side. And it's not, we can't always say that because the data, a lot of the data can be quite mundane when you're looking at it and you're just basically looking for beats. Is it missed? What does it mean for the Fed? Does it mean anything? What does it mean for the Bank of England? Does it mean anything, etc.? And the data that we've got this week is quite an interesting selection if you are following the broader stories. So hopefully right now you can see the MarketPulse website. For those of you who aren't aware, this is where we upload our content every day. We've got analysts around the world. You'll see that the podcast, which we record on a weekly basis, is actually just on there now. So apologies for my ugly mug. This is where we effectively upload all the content. It's also later on where you'll be able to find the recording of this webinar if you want to revert back to it. But it's also where you find the economic calendar just here. And this is what effectively details out all of the major events this week. Now, I've filtered it down by, firstly, the countries which are relative to the currencies, which I'll be looking at in today's webinar, and then the medium and high impact events, because the low impact events, well, they can be of interest, and sometimes some do slip through the net. So things like the EIA crude inventories are low impact events on the economic calendar, but obviously they're very much not in real life. These things can take some time to catch up. It does capture most things which are important during the course of that week. So I've filtered that down. And as I said, I feel like there's 3 things this week which really stand out for me. And I'll start with the UK one. And it's the fact, from a UK perspective, it's very much that there's 3 batches of data which give a very good broad picture of how the economy is looking right now. The first one was released today. We had the jobs report. So we saw unemployment remained at 3.9%, earnings at 3.5%, and excluding bonus at 3.4%. So this was all in line with expectations, which is why we won't have seen much of an impact on the actual pound itself. But it's still interesting, and the reason is because despite all the Brexit uncertainty, despite the fact that we are seeing a global economic slowdown, despite the fact that the economy is actually growing at a relatively slow rate at the moment, we have a very low rate of unemployment, the lowest since 1975. We're still seeing earnings growth continue to tick along, which is very encouraging. There are obviously going to be various factors which are contributing to that wage growth. Some which are good, some which are less good, but we are seeing a solid wage growth right now, which is encouraging from an economic perspective. It's not necessarily filtering through into the economy itself, but it means it has the potential to, once we overcome the Brexit question, which is ruining politicians' lives at this moment in time and frustrating everyone else. So that was one very encouraging piece of data this morning. Then tomorrow we've got inflation data. Now this would have been more important for me if that Brexit conundrum would have been resolved and the UK left the European Union on the 29th of March or the 12th of April, or if it was leaving on the 22nd of May, then this would have been more interesting. The reason being, central banks around the world have taken up a far more dovish tone recently because of the slowdown which we've already seen that has started. The warnings of a slowdown which we have seen from various central banks now and various other institutions like the IMF, the World Bank, etc. They've taken a step back. They've decided there's no need to raise interest rates in the near term. We can sit back, hold on, and someone like the Fed, who's been raising rates for the last few years, has very much afforded itself the ability to do so. The UK central bank, the Bank of England, was the one central bank I thought could actually deviate away from this. And the reason is simply because over the last couple of years, they've not raised interest rates as much as they would have wanted to. The Brexit situation, the uncertainty caused by it, has dramatically impacted that. So we're now in a situation where we've got a very tight labour market. We've got a very, we've got wage inflation, which is at 3.5%. We've got inflation, which is on target, and we've got interest rates, which are still below 1%. So I think the Bank of England, once the Brexit uncertainty, once the cloud had been lifted, I think the Bank of England would have been keen to raise interest rates this year. That I don't believe will still be the case. They could still go later on in the year, but they're going to be in less of a rush to now because that cloud of uncertainty has not been lifted. The data, of course, could still encourage them to do so, and they may also be encouraged by Parliament's complete opposition, almost complete majority opposition to a no-deal Brexit. So they may see that risk of being subsided. But when the economy is growing at such a slow rate and the global slowdown is happening, they may also just decide to hold off a little bit longer. So I do see this as being slightly less important, but not completely irrelevant, because as I say, inflation is still at 1.9%, or expected to rise to 1.9% on a core basis. If this goes at 2% or above, then perhaps people will see that as a sign that the Bank of England may actually decide to step in, add another 25 basis points. Probably not till the second half of the year, I would imagine, but you never know. It'll be interesting to see what they've got to say, especially with once we hear from them post the Brexit extension being agreed. Then on Thursday, we've got the UK retail sales. And again, the UK economy has slowed down, obviously. Retail sales continue to be strong. Like I say, year-on-year growth at 4.5%. I think that's extremely strong. But at the same time, we are hearing plenty of evidence that consumer spending is slowing. So it's about where the consumer is actually spending their money. So the economy as a whole is slowing. We're seeing the high streets very much are slowing down. And we are seeing plenty of evidence elsewhere that we are seeing a much more conservative consumer, and that takes its toll on the economy, which is more than 75% driven by services sector, and I think around half of that is retail sales. So this is very important data. We need to continue to see these prints, and if the Brexit uncertainty continues to negatively impact the retail sales data, then it will have significant impacts for the economy. And as I say, 4% is obviously looks very good. But when you look at late 2016, we were going at above 5% just after the Brexit vote and the run up to the Brexit vote. So we've obviously seen the sharp drop off since. This has recovered somewhat, but that doesn't mean the uncertainty can't continue to weigh. So I think this is a really piece of important data. So what you get from these three pieces of data is you get a nice rounded overall view of the economy. How is the labour market? What are people's earnings like? What are they doing with it? Are they saving it or are they spending it? And what impact is that having on inflation? These are all extremely important metrics as far as the Bank of England is concerned. And as I say, Bank of England very much one of the few central banks that will probably still be considering a rate hike this year, but certainly would have been in the event of Brexit happening on the 29th of March. The second batch of data, which I think is important this week, is Chinese GDP. Simple reason being, the slowdown in China in the first quarter of this year, that has been perceived, the impact that we've seen from the PMIs, the impact that the trade war with the US has had, the potential for the global economic slowdown to have a severe negative impact as well. All of these things could have weighed on economic activity, and we're expected to weigh on activity in the first quarter. What that impact that has overall, though, is a lot of other countries depend on China for their own growth, and we've seen what impact slowdown in trade between Europe and China has had on economies like Germany, who do a lot of trade. But there's a lot of other countries as well which do a lot of trade with China. This is very much a case of at the end of the day, this is the world's second largest economy, and if you see a slowdown there, it is going to have negative ramifications for all concerned. So that's why the trade war between the world's two largest economies is so concerning, not just for the US and China, but for everyone else as well. There's that old saying, is that when the US sneezes, the whole world catches a cold. Well, I very much think that the same applies to China here as well, because they are extremely important, and they're becoming increasingly important as we go. Again, look at Germany, for example. We've seen the slowdown that we've seen in the automotive sector there. One part of it has been driven by the changing testing standards that we have seen, that are diesel emission testing, and the changes which we've seen there have created a slowdown in the actual testing of the engines, and it's created bottlenecks in the system. So that's slowed down activity here. But another major factor has been where they export to, and one of the major markets that they were exporting to, and the same as in Italy, is China. And we've seen, I believe it was subsidies are being removed, which has raised prices quite significantly in the Chinese market, and that's made cars from Germany, etc., far less competitive and far more expensive. And we have seen an overall decline in new car sales, I believe, in China. Don't quote me on that, but I believe that that is the case. So this just goes to show what kind of an impact China can have on other countries as well. So I think everyone's going to be very interested to see whether fears of a slowdown in China in the first quarter of this year were real and founded, or if we see this number B, if we see 6.4, 6.5%, 6.6%, could that provide a massive boost to the markets? Would that tell us that, yes, there has been a slowdown elsewhere, and yes, economic activity isn't as good as it used to be in China, but growth is more sustainable and less volatile than people fear? And the fact that this coincides with retail sales, industrial production, foreign direct investment, etc., I think this morning on Wednesday could be a very keenly followed batch of releases. And then finally, we've got the PMIs from the Euros, from Germany, the Eurozone, and France on Thursday. And you may ask, why is that so important? And there's only one reason, really, and that is the fact that the German manufacturing PMI last month had a major impact on the markets. When the German PMI came out at 44.1, which was well below expectations, was sharply in contraction territory as well, we actually saw a sell-off not only in the euro, not only in German stocks, but wider European stocks and US futures. It carried over because the reason behind the slowdown wasn't just German impacted, it wasn't just German focused. It was a slowdown in trade, it was a slowdown in the global economy, it was the impact of China, it was the potential for a trade war between the US and Europe. There was a group of factors, all of which were much wider ranging than just Germany's domestic market. And that sent shockwaves throughout the entire financial system and triggered this sell-off. So if it's happened once, it's very much worth paying attention to these numbers again, because it has the potential to have wider ramifications once again. So that's the data which I think is going to be most potentially impactful this week. There are other economic releases along the way. I'm not saying ignore them. Things like Eurozone inflation is interesting, but we're not expected to see a rate hike until next year at the earliest at this point. So maybe not quite as impactful as it has been in the past. Same, we've got inflation data as well from Bank of Canada. We've got various speeches, Mark Carney and Bullard and various others speaking throughout the week. It's always interesting to hear what they have to say, particularly the central bank heads. US retail sales, of course, is important. I'm never going to overlook that. And things like building permits, housing starts. All of these are important pieces of data, but the three batches I've named there for me really do stand out, and they're the ones I'll be paying much closer attention to this week between now and Thursday. Of course, on Friday, we have a couple of pieces of US data. The lack of European data is simply because it's Good Friday, and that's a bank holiday here in the UK. I believe it's a bank holiday in the US as well, actually. But clearly, we do have a couple of pieces of data coming out on that day. I imagine it's going to be a much quieter session, though. So let's move on to the data. It's amazing. You take Brexit out of the conversation, and all of a sudden we've got a lot more time for charts. As ever, please do send through any questions that you have. If there's any charts that you want me to take a look at that I'm not covering, then by all means just send that through. The more engaging this is, the better, and the more questions that I'm able to answer of yours, the more useful these sessions are. So Any questions, please do send them through. And also, if you've got any comments yourself on the charts, which I'm looking at, even if they disagree with me, that's perfectly okay. Just speak up. I'm always open to other views. So where are we with euro dollar? Well, we have seen obviously a continuation of this little short-term uptrend that we saw that we were talking about in the webinar last week. But we have run into resistance around that 50 fib, just above 113. On 3 of the last 4 sessions, we've come up to this level and we've run into a little bit of resistance. That doesn't necessarily mean to me that we're coming to the downside though. We saw the nice little rally this morning. Now, what was interesting about this morning's rally off the lows is that it wasn't the German data that actually triggered it. So you'll see here that we did have some German and Eurozone economic sentiment, the NZDUSD surveys. Now, this is when we saw the volatility really pick up in the euro. And you would have thought that, well, economic sentiment in Germany up 3.1, up from minus 3.6, 4.5 in the euro, up from minus 2.5. You would have thought that this would be positive for the currency, but instead we saw a lot of volatility, but the actual initial reaction was the sell-off. Now, you may argue that the reason for that is because the actual current assessment part of the release was negative. But I'm not too convinced, and granted, it looks a lot larger because volatility has been constrained and we only fell back to 112.80. But I feel like this was a bit of an overreaction, and the price action that's followed back towards the kind of pre-release levels really do just confirm that for me. I think this is a positive piece of data. I don't think it's anything worth getting carried away with by any means, but I think this is a positive piece of data. Whether that's enough going to get us through that 113, just above 113.50 fib levels, I'm not so sure. But what is interesting is, while we have run into resistance here, we're not seeing strong rotations to the downside, regardless of that volatility we saw this morning. That suggests to me we're just seeing consolidation here. That suggests to me that momentum, at least for now, is still with the bulls, and we may see another run or two up towards these 50 fib. If that gives way, then my eyes will immediately go to these kind of 113.50 levels. This is where you've got the 61.8 fib. You've got the 89-day simple moving average, followed less when we're in these kind of sideways trending markets, but the fact that it coincides with the fib level just adds a little bit of interest as far as I'm concerned. And if we do go through those kind of 113.50s, then again, attention goes into this kind of area here between these two trend lines. Again, for those of you who follow my webinars normally, I don't tend to look for individual trend lines. I look for areas of support and resistance. I just think it makes more sense. I don't think trying to find to the pip what the specific rotation point is going to be is very useful. I'm just looking for areas where we could potentially rotate off of, or breakthrough would be significant. And we've got these two long-term resistance, support and resistance trend lines where we have clearly seen price action run into resistance before. So if we go through that 61.8 fib through 113.50, then my eyes are automatically drawn to here. So the area between the kind of 113.80 to 114.10. And again, you've got the 233-day simple moving average band there again. Again, an area of potential support and resistance rather than a level. And we can see price action has rebounded off here on this occasion in March, on this occasion here in January. We went into the band here back in early January and rotated lower. So therefore, it makes it a notable area of potential resistance again if we do get towards these kind of 114 levels. So for me, that makes the area of interest as far as I'm concerned above here around the kind of 113.80s through 114.50s. Again, it doesn't need to be specific. If it is important to you, then that's completely your choice. But for me, the specifics aren't that important. So this kind of entire area here becomes extremely notable. But what the move through 61.8 fib does for me is it suggests that we're not yet seeing a rotation back towards these lows, and the overall trend very much is lower. The reason why my eyes are up here is quite simple. I think a break higher is far more interesting than a move lower, because we've seen plenty of moves lower recently and we failed to pick up any momentum to the downside. Potentially significant is the fact that we failed to make a new low this time despite coming very close. We'll see how that materializes, but I would love to see a breakout here. Simple reason being, I think that would be accompanied by a nice pickup in volatility as well, and we all love a bit of volatility. Cable, Brexit has sucked the life out of it, I'm afraid. It sucked the life out of the pound. We've left us range bound. We're not really even seeing that much volatility within the ranges at this moment in time. We're very much in consolidation mode. You can see that we've kind of got these 50 pip plus range daily ranges. I'm not really seeing too much of interest here, to be honest. It could be a slow week or two, if I'm honest. The data had the potential to do something. Of course, this morning's releases were very much in line with expectations, so we haven't even caused a wobble really. But I think the data over the next couple of days has the potential to create a little bit of volatility. But the problem that we have is Brexit is kind of sucked the life out of it, and the fact that we've just kicked the can down the road doesn't really help matters. What I am curious about is since the middle of March, so for the last month, we've seen a few runs lower at these 130s, which has held us support for now. But we've seen lower highs in the process. So I'm wondering whether we're seeing a bit of profit taken. I'm wondering whether the rallies that we were seeing in the pound prior to this, during this period here, was either a bet on either A, that a deal would be achieved, and I was very much one of those who thought ultimately, as we got closer to the deadline, we would find an agreement. Disappointed is not the word, but the fact that we are just kicking the can down the road is, I think, frustrating for everyone. And I wonder whether the rally that we saw here was almost a belief that a deal would be achieved, or at the very least an extension. Now, if once we see the extension, then you have to wonder whether that's priced in. So when it became evident around these areas that an extension was looking increasingly likely, I'm wondering whether we started seeing some profit taking on those long positions, because we're going to have to wait. We could wait up to 6 months for a deal to be achieved. I remember saying at one point that a breakthrough 130 would suggest potentially that a no deals become more likely. I think at this point, a breakthrough 130 could just simply mean that we're seeing profit taken on those previous long positions, and we're back in wait and see mode to see how this starts to transition over the next few weeks. It's worth noting that the UK desperately doesn't want to take part in European elections, and if that's going to be the case, then we effectively need to leave by the 22nd of May. That means getting a deal through Parliament that the EU's agreed on, whether that's Theresa May's deal, whether it's the alternative compromise that Theresa May works up with Jeremy Corbyn and the Labour Party. We'll have to wait and see. But so there is potential for this to pick up on us not having to wait 6 months. But at the moment, I feel like the downward pressure that we're seeing is being built up by profit taking at the can being kicked, rather than anything else. And there is potential, therefore, given the fact that we are seeing this downside pressure, for that 130 could eventually give way. But at the moment, it seems that all volatility has just been sucked out altogether. And the same is true on all sterling pairs. So rather than repeat myself, I'm just going to talk about key levels when it comes to sterling pairs, because the story is very much the same. In this area here, again, as I said before, I look at areas rather than levels. And this may look like broad areas, both upside and downside, but quite frankly, I don't care. What's interesting to me is what a breakout would mean, or whether we are seeing a remain inside. And it's not even a wider range, but that's just where we are. Now, we're back in this 86.20 to 87 range. What's interesting for me is we're not rotating lower, and momentum is still very much with the bulls. So this kind of confirms what I was saying with cable as well. We're consolidating here, but we're not reversing course. We're not even correcting. This suggests to me that we could potentially see another run higher. I'd love to see a break of 87. For me, that would signal could be the catalyst for more volatility, for a nice for a nice big move. It's by no means guaranteed, and while we're in that area, I will be keeping a close eye on the momentum indicators, because if we remain in this area making slight new highs and momentum gets sucked up the move, that'll suggest to me that we're potentially just going to remain within. But interesting times potentially if we can just get through that 87, potentially triggering some volatility, potentially triggering some tasty looking moves. But at the moment, we remain range bound. Aussie dollar is another one that has potential to become very interesting as well, but I fear it won't. Now, you'll see from the chart, the 200 to 33-day simple moving average band has been a reliable area of support and resistance now for some time. More recently, over the last week, we can see back here again in February, back here in December, we went into the band and we've rotated lower. The same was true here back in April, shortly after we actually broke below. And prior to that, it was support on the way up. When it was sideways traded, it was chopping between the two, but when very much not been sideways trading over this longer period of time over the last year. So now that we are approaching this level again, for me, if what you're interested in is big moves and volatility, then what I want to see is a move through these kind of 72s, a move through 72, could be the catalyst for a sharper move higher. It would take us through resistance, through this falling trend line, through the moving average band, and back, and has the potential to be that squeeze higher. If we do see a move through 72, then 73 becomes interesting. That's the most recent high here, and potential resistance again. And then, of course, then we're looking back at like at previous highs again. So you're looking maybe 73, 75 through 74. But the most important thing for me is if we can see a breakthrough here, I think that could make things very interesting. My fear is that we'll continue to see what we've seen previously. Rotations off the moving averages, consolidation, lower highs, which is still what we are seeing right now, and a squeeze back towards these lows. That is very much has the potential to be. But there's only so long this squeeze can go on before we have to see a break one way or another. The problem is that could be a month or two. I'd love to see a break higher. I'm hopeful, but I'm not confident. So this is very much a chart that has potential to become much more interesting, and my fingers are very much crossed. The dollar CAD, again, we're seeing a squeeze. Unfortunately, this is very much a trend with many currency pairs. We're seeing a squeeze here on dollar CAD between these rising and falling trend lines. I still think this looks bullish near term. The simple reason being that I don't feel like we've seen the completion of this kind of rotation higher once we saw this bottom out here. But the thing with the triangles is they don't give you directional bias. I'm purely basing this on the fact that we had this kind of bottoming pattern here. It's an imperfect one, but it would suggest to me that maybe we could potentially be more in this area here. That hasn't materialized yet, and if we see a break through the top of the triangle, then I'd want to see a break here of the kind of 134.70s, the previous highs. Potentially that would give us the momentum to get back towards those levels. Ultimately, though, what I'd like to see is a break through the lows, and the simple reason for that is, as I've just said with the Aussie dollar, I feel like this is the path of least resistance. This is also the path of low volatility and slow rallies. I feel like this here is the path of more resistance, but also the potential path for greater volatility, sharper moves, and more interesting moves. We've been in this long-term uptrend for some time, rising in this channel. You can see that it's not perfect, but the moving averages, the 200, 233, have been notable. But again, we've seen moves below them before rotating higher. So I'd probably pay the fact that it coincides with the moving out, the rising trend line, potentially could be interesting. But this is the move I'd like to see. But again, I feel like this is the path of least resistance right now. Time will tell. Potential for a very interesting chart, but at this moment in time, not so. Sterling CAD, the story is the same. I feel like I'm just looking at a cable chart, to be honest. Range bound 173.50, 178, 173.50, 174, 178. We've got a peak here, but we've got lower highs. Potentially some profit taking. Contributing to the downside here is the fact that we have seen a rally in oil prices, which is typically correlated with the Canadian dollar. We're just seeing consolidation. We're not even seeing that wider range right now. If we can break through these 76s through this previous peak, then that could potentially give us a little bit of momentum up to the upside back towards these previous highs. But ultimately, that keeps us within this range. Almost again, I feel like there's a difference between what I want to see and what I half expect to see. The path I'd like to see would be a break below 173.50. I think this would just be far more interesting at this moment in time. I have had a question: how come my daily charts are not the same as yours? The daily open, high, low, close are not the same. To be honest, I'm not entirely sure. Obviously, I can't see your charts. Perhaps reach out to me on Twitter later on. If you add me on Twitter, Craig_Forex, I'll add you back, and then you can send me a chart across and I can take a look. But without being able to see your charts, I'm not entirely sure why your charts would be any different. They should be exactly the same. This is a live chart. These are live rates. These are live moves. So there should be no difference. So I'm not entirely sure. So I'll try and help you out later on, but there's not much I can really do at this moment in time. Like I said, I would like to see a breakthrough this 173.50s. We'll wait and see if that materializes. a breakthrough the 176, 176.20 highs previously could potentially make this a bit more interesting, but at the moment we're just in consolidation, unfortunately. Kiwi dollar, again, I feel like I'm getting repetitive now, but we're very much in a sideways trend. We've got 69.50, 70, what maybe this kind of area here to the upside, and we've got a kind of 66.80s, 67.30s roughly to the downside here. If we can see a break through that zone, that would be lovely. But again, I'm not really seeing signs that it's happening, unfortunately. We're in consolidation mode, though. It kind of feels like kind of a late summer vibe right now with these kind of tight consolidations. At some point, these do tend to break out. It's about being patient, but when they happen is another thing altogether. Again, like I say, if we can break through these kind of through back below 67, potentially put some pressure on the downside, this could become a lot more interesting. But right now, we've seen 2 attempts at it. It's held on both occasions. And the only positive is that we are seeing a series of lower highs along the way. So that potentially keeps some pressure to the downside. Gives me some optimism that a breakout could happen. It's just a case of when. I'll wrap things up as ever with the yen pairs. I've run a little bit over today, but not as much as normal, thanks to the lack of Brexit chat. So hopefully most of you have been able to stay. In terms of dollar yen, again, we are range bound. This is almost frustrating, but 110 to the downside, 112 to the upside. We are at least testing those highs. I'd love to see a break through those highs because I feel like that would give us a nice little catalyst, potentially, a potential catalyst for a move sharply higher. We are consolidating at the highs, which gives me hope that momentum remains with the bulls and can actually hopefully just squeeze us through those resistance levels. Again, the next resistance area for me is around these kind of 112.70s. Not hugely significant, but we do have this kind of falling trend line here, so we could potentially run into resistance here. If we do break through these highs and run into resistance around these levels, then the key test for me would be the test from the upside to the downside, looking for confirmation of the initial breakout. If we bounce off here and we rebound higher again, that could be a nice little bullish signal, potentially getting ahead of myself. But for me, I'm encouraged by the consolidation we've seen having run into these highs. A lack of a rotation lower, a lack of a correction suggests bulls are very confident. For me, I would be a bit of a nervous bear there because we've not seen much of a corrective move. It would suggest that pressure is going to remain to the upside. No guarantees as ever, and obviously not advice by any stretch of the imagination. But that has the potential to become an interesting chart, one I'll be keeping a very close eye on again. Your sterling yen less so. Everything that I've said before applies. We've got the low here around the kind of 144, 145 area. We can see that this has been support resistance since the back end of last year, and we've got the cloud below here. We've got the moving averages all combining, all 4 of them. A break below here would be really interesting. I'd love to see a break through that 144. Potentially could be the catalyst for a nice sharp move lower. You can see that what is kind of 142 area has recently been notable support. So we could that could potentially be where price heads towards in the event of a break lower. It certainly looks like it could be a potential area of support if we do break lower. I'm naturally getting ahead of myself, but what I'm encouraged by as well is that we've got 2 highs here. We've failed to break higher. This is the range high. We had a new high here around in early April, and we've had 2 attempts to break here, and we've fallen short on both occasions. So that could potentially be a bit of a bearish signal. The thing that worries me is that we haven't seen a real correction lower, so it's kind of similar to dollar yen. We haven't seen this kind of corrective move lower, so I fear that we could actually be headed actually back towards these kind of range highs and more sideways trading. Like I say, my preference is always the thing that sparks more volatility, that sparks the potential for greater moves. And for me, that would be to the downside through 144. It would also take us back through the cloud formation as well, and therefore be typically a bearish signal. So one of potential interest. Euro yen, again, in a very similar way to sterling yen, is we've been choppy through the cloud, which is never encouraging, because it suggests that we're in a sideways rangeless market or range bound market. we're struggling at these previous highs again, but we're not seeing much of a corrective move, which suggests to me that the path of least resistance may be to the upside. If we do get to the upside, that's not necessarily the end of the world when it comes to this particular pair, because perhaps one of the reasons why the yen's struggling right now is because we have seen a return of risk appetite in the markets, and the yen is seen as more of a safe haven currency. So the fact that the dollar is looking more bullish against the yen, the euro is looking more bullish against, and even the pound is looking bullish against the yen, potentially a sign that risk appetite in the market's returning. So this is where you can sometimes see counter trend moves compared to other pairs, particularly when you're looking at something like the pound. So, but to the upside, if we do see this rotation higher than 127.50, very much looks like a very really key area for me. It's prior support, prior resistance, most recent resistance. So we've got the 200-233-day simple moving average band, but it's also longer term support as well. If we can break through this kind of area here, then that could be a nice little bullish breakout, and potentially that could be the catalyst for I lost my train of thought. That could be the catalyst for a more bullish wave. In terms of where we go, though, obviously it's always difficult to say. But if we look at the most recent price action, just above these kind of 129s is where we've run into resistance before. So that could be potential resistance again in the event that we do see a break through these levels. But I don't think it's going to be straightforward. It is encouraging, though, that we are seeing only consolidation here in that previous resistance area rather than a corrective move, because that very much suggests bulls are in control. And that wraps us up. So I hope you all found that useful. I really hope you have had one last question. If oil goes up, which is it? Which is it? Bullish trend? Will dollar CAD outlook be bearish since CAD will strengthen? So the thing worth considering, Nita, always in these situations is the moves in oil are correlated with the Canadian dollar. But when you're looking at a currency pair, there's two factors that are driving that pair. One is the Canadian dollar, and the other is what it's measured against. In your case, the dollar. So we do often see that the Canadian dollar is correlated, but that doesn't necessarily mean that if we do see oil strengthening, that will naturally drag us lower. It means that it'll be downside pressure, but it won't dictate the entire direction of the pair. If we're seeing the dollar rallying against all of the currencies, and we're also seeing oil rallying as well, then this could create consolidation in here. If we've got two strong currencies against the other, it could actually mean that the price moves high because the dollar is the dominant currency at that moment in time in terms of the strength of the rally. The other factor as well is that oil is priced in dollars. So when you see a stronger dollar, it's actually a bit of a headwind for oil prices. Again, that's more of a correlation type thing, but it's not a guarantee. So if you've got a dollar that's strengthening strongly, then the chances that you're seeing oil strengthening strongly as well are a little less common. So what that would suggest to me is that the chances of oil and the dollar strengthening at the same time would be slim. So if the dollar's weaker and the oil's rallying, then that would be, you would suggest, a bearish factor here and could potentially bring some pressure to the downside. But it all depends on the various circumstances rather than just oil rallies and therefore dollar CAD moves lower. I hope that makes sense. So on that, I will wrap things up. Thank you very much all for joining us. I hope you all have a fantastic week of trading. I hope you'll join us again for the session next week. If you've got any questions, don't hesitate to reach out to me on Twitter. Again, it's Craig_Forex. Please do check out MarketPulse website for all of our daily content. And also check out the two podcasts which we are now doing. There's the OANDA Market Insights released every Friday, looking at the week ahead. That's OANDA Market Insights. And then there's OANDA Market Beat, which is usually released in the middle of the week. And that's by my colleague in Toronto, Alfonso Esparza. And the recording, of course, of this will be on the YouTube and MarketPulse channels later on today, and I'll also tweet it out. And apart from that, again, have a fantastic week. Thank you very much for joining us, and I'll speak to you all again next week. Thank you.